Analysis Jamie Dimon might want to send Powell a thank you. NIE is the difference between the amount a bank earns from assets like loans and the amount it pays on deposits and other funding. In its third quarter results on Friday, JPMorgan and Wells Fargo reported NIE increases of more than 1.3 compared to the same period last year, while Citigroup increased by 1.5. The amount of money that banks spend on potential bad loans is growing, but not each of the terms offered in the third quarter was not much different from the amount they offered in any quarter of 2019 before COVID-19 and inflation were rampant. U.S. banks must set aside money for all of the credit losses they expect over the life of the loan under recently introduced accounting rules that Dimon detests. Told analysts that if the unemployment rate rises above 5%, that means the bank has to make an extra $6 billion in provisions over a couple of quarters. Higher rates mean more people will struggle with their credit card bills, but also because it increases the likelihood that the economy will deteriorate further. It makes the overall unemployment rate likely to be 8% higher than it is today. That $6 billion figure compared to $1.5 billion in provisions for the third quarter of this year and $10.5 billion in the second quarter of 2020 is the highest for COVID-related contingencies, most of which are never needed. Dimon doesn't like this rule because it makes earnings more volatile and doesn't reflect actual losses. It is meant to ensure that banks cannot spend too long pretending that their loans are better than they are now, but the extreme changes seen during COVID have made the rules seem less reasonable than they should be.